Dividend investors, bonjour, Mikey Hu here, founder of Dividend Stocks and passionate investor. We are in the middle of the earnings season. Are you excited yet? Last week, all the big techs declared their earnings. We had huge share buybacks and dividend increase from Apple. Microsoft growth double digit, even though the market expected more. I mean, sometimes you wonder like if the market will never stop expecting more from those companies. Facebook was on fire, Google as well. So all pretty much very good news in the tech world, and we keep receiving earnings report every single day. And it's actually very hard to follow all of them. So today I want you to share with you my methodology for each quarter, what I do during the earnings season with my portfolio, as step by step, easy to follow, maybe that you don't have this kind of like follow up on your investment. And honestly, I think that if you don't track your money, you will eventually put your portfolio at risk. So every single quarter, during the quarter, I will read headlines and so on, but I am not super excited about looking at what's happening on one place or another. I'm not chasing the news either, so most of the time I just got them from my Twitter account, but I will not take that much time to look into each quarterly earnings right away. So you probably wonder why I don't chase the news. Is honestly, if there's something that is catastrophic happening to one of my holdings and I didn't see it coming, like an unprecedented event, it's already too late. When the news is out, the market has already spoken, and if the stock has to drop by 10%, it's already done. And then if I trade on the same day or the following day, I'm just like chasing the trend, and most of the time I'm just going to make a mistake. So instead, I just read in the headlines like here and there. I keep myself busy with other things, and at the end of the quarter, I will receive my DSR Pro report, which is basically a report telling me what happened over the past 3 months. It gives me a little bit more time to digest some news, to think about it, and not trade on emotion. So the first thing I do when I receive my report is I look at my asset allocation. The asset allocation on my side is pretty easy to follow. I'm 100% invested in equities. As you can see on this graph right there, for sector allocation, I have like 0.15% in cash. So when I'm telling you that I'm always invested, I mean serious business. I think it's the best way to protect my money. Actually, it's to get it work for me all the time, 24/7, and pay me dividend. What I look in terms of sector allocation is I try not to exceed too much 20% per sector. As you can see, I'm already overweight on technology, consumer cyclical, and I have like financial services is still good, but it's still getting close to 20%. It's not the end of the world, but it's just to be aware that if there's any tech bubble at one point and it bursts, I have 25% of my portfolio at risk. So that's the first thing to do. Look at your sector allocation and make sure that you're comfortable with that. Fellow Canadians, please take a big note on that. If you have 4, 5, 6 Canadian banks, chances are financial services concentration is huge. It's overweight over there. And then if you suffer from a credit crisis, a mortgage bust, housing bubble, whatever, your portfolio is greatly at risk, and you might want to reconsider that once again. So this is just to take some notes and to also highlight, the fact that I'm very low on energy, which will not surprise many of you here that have been following me, but I'm also low on utilities. This is being explained by the fact that I'm more geared toward a little bit more growth right now than high yield or stability. But even then, a little bit more utilities, a little bit more REITs could actually improve my portfolio asset allocation. And those are the things that I have to take in mind before I start digging a little bit deeper. The second step I do is I will look at 2 ratings that are being generated by my report. The Pro rating report, which is telling me basically it's a global appreciation from 1 to 5. I've already made a video about Pro rating and my dividend safety score that we do at DSR, so you can watch them in the link description below. Overall, the idea here is not necessarily to sell you DSR. It's actually, you can do that yourself, just a little bit more work, but try to rank all your stocks from from your favorite to your least favorite, and then try to determine the dividend safety of each of those companies. So then you can look at the dividend triangle, as I often mention, so which is revenue growth, earnings growth, and dividend growth trend. You can look at payout ratios, at debts, and etc. But the point here is to determine, am I holding winners in my portfolio, like companies that I believe they will thrive in the next 5, 10, 15 years from now, and is dividend safe? I'm talking about not only the dividend payment, but also I'm looking to get dividend growth. As you know, most dividend growers tend to outperform the market with less volatility over time. So those are like basic rules, and those two graphs will tell me if my portfolio is healthy or not in terms of stock picking. When I look at my pro rating right now, I see a lot of green. I love it. I see a little bit of yellow, which counts as old. It's all good. I don't worry too much about that part. And it's normal that at one point I don't have only just superstars in my portfolio. It's pretty much like you build a hockey team. You cannot have, like, we wish we could have Draisaitl, McDavid, and then we would have Tavares and Austin Matthews and Mitch Marner and so on our team, right? But at one point it's not possible. They will all want more ice time, and you cannot give them to them if you're their coach. It's pretty much the same thing with your portfolio. What worried me during the last quarter, though, is my dividend safety score graph. You see there's a little bit of red there called for dividend trash, which is pretty self-explicit. Those companies are actually CAE and Disney because they suspended their dividend last year. So I suffered a dividend loss over there, but those two companies had to suspend their dividend because of the pandemic, not because they're doing a bad job. I decided to keep them. They're still highly profitable right now, so I don't worry too much. However, there's this tiny little piece of orange in my portfolio, and I was like, what is this? What's happening here? So then I took another note, and I'm like, you know what? Now it's time to look at this one and identify it. So this one is Hasbro. The general rules that we use at DSR to determine a dividend safety score of 2 and 2 out of 5, you can expect that it's not that great. So 2 out of 5 means two things. Either the company is likely to cut their dividend or about to do it because they're not doing anywhere, which is not the case with Hasbro because the dividend is safe, the payout ratio is healthy. But the second thing that we do is we use the dividend safety score of 2 to highlight companies that kind of like forgot their mission to reward me as a shareholder. Hasbro has not increased its dividend over the past, I think, 6 quarters now. So obviously at one point it just fell into a 2 category. It was a 3, went down to 2, because an absence of dividend growth is not a good sign. Doesn't mean that I have to sell it right away, but then again, I have to take that box, put Hasbro on my watch list, and continue my process. So far, I've looked at my sector allocation, and then I've looked at my ratings. The next point that is super important according to what I believe when I invest is to look at the weight of each stock in my portfolio. In an ideal world, I will have only companies at like all 3% or 4%, and they're all equally weighted. But we all know that even though I started my portfolio like this, life gets in the way, fluctuation gets in the way. Some companies are doing so much better than others that at one point in time, you have this kind of distortion between all the stocks. So now when I look at my Lira account, which was my pension plan that I had at National Bank, I decided to take the money and invest it in 2017. I have like weaker, smaller position such as Lazard or at like 2.83. I also have Fortis at 2.61. So small position. And on the other side of the spectrum, I have big tech stocks. You know, it kind of makes sense because I'm overweight in tech stocks as well. But Apple, Microsoft, 7-8%. It's still a lot of money to be invested in single companies. When I look at those two businesses in particular, I feel good about them. They are well diversified. They're generating cash flow like there's no tomorrow. Their latest earnings, and this is what I will look at in the next step, is to look at each earnings one by one. Latest earnings were great. Double-digit growth, lots of money, as I mentioned earlier. Apple even announced a $90 billion share buyback program. a dividend hike. So all good there. I'm not too worried about this part, but still I have to highlight it to make sure that I am following my plan. And at one point, a company like Apple or Microsoft is not like 15 or 20% of my portfolio, because at this point I would be better off to sell a few shares to reduce my risk on this company, because the day that it drops by 35%, I'm not going to feel good about it, and to buy other stuff. I did it in the past with Apple. Right now, it's not necessary because it has been fallen into in line with my portfolio diversification. So I can move on to the next step. So the next step is going through each quarterly earnings one by one. And I know it seems like a very daunting task and maybe not that sexy and exciting for you guys, but if you don't do that, you may miss details, you may miss a direction or a comment from the CEO that will tell you a lot about the current business, but also where the business is going. So it's not just about what just happened, but where the company intends to find growth in the future. At DSR Pro, what we do is we have a team of analysts. We have like 4 analysts, and they go through that work for you and they make a summary. So this makes my life easier, obviously. And then I can just scroll down, look at a few details, the variation, and just see if there was like a big announcement or anything. It will be in the summary, and if there's one, well, then I will go click on the press release, take a deeper look, and try to understand what's going on. So in this specific case, last quarter, what I did is I looked at Hasbro, obviously, because Hasbro was not rated well on my portfolio, and then it kind of like gave me a clue saying, you know what, maybe I should give a little bit more thoughts into this one. So I look into Hasbro's quarter, which was relatively good. The company is generating good cash flow, and management is confident they will post double-digit revenue growth this year, which is quite encouraging. But the fact that the dividend didn't increase, and when I look at the dividend triangle, I kind of like realized that revenue were sluggish over the past 5 years. Earnings was the same thing. No more dividend growth. The stock price has been lagging as well. And now I'm thinking, there's a big part of that business that is still making like classic toys. We're moving to digitals. They're trying to make this shift, but it's not natural necessarily. They have made an interesting acquisition with E1, Entertainment One, for more content. But then again, I already have Disney, which is pretty much tied to Hasbro. And well, actually, it's more Hasbro that's tied to Disney because they're making their figurines and action figures and stuff like that. And then I thought, you know what? I'm not too sure I want to keep it, but I was still a little bit in that paralysis by analysis phase. And then I go to my next step, which is kind of like my secret to get rid of those laggard in my portfolio, those companies that are not doing very well and they have okay rating, but it's just giving you that sentiment of like, meh. So my secret, my weapon is to build a replacement list. So try to get excited about other type of stocks. In this specific case, I went back to my sector allocation. Remember, I told you I'm heavily weighted into tech sector and consumer cyclical. Hasbro happens to be in consumer cyclicals. So there's one thing here. I'm like, you know what? I can decrease my exposure to this sector and find another one. Remember, I told you I wanted a little bit more utilities in my portfolio. They're great. They're stable. That could bring a little bit more money into kind of like a deluxe bond environment, since I don't have any bonds or any fixed income. So companies that will not react to the market too much compared to what we have in the tech stock industry, for example. So what I did is I went back to my research, used DSR tools, obviously, because I have them. So I can search by utilities on the stock screener, then look at pro ratings that are over 4, dividend safety score over 4. And I thought, you know what, in the utilities, as I mentioned earlier in another video about the top Canadian utilities and renewable energy stocks, Algonquin, AQN was one of my favorite, and it has been on my radar for a while. Didn't have the liquidity to buy it, and this time I decided to pull the trigger for that reason, because it was already there. And when I look at Algonquin versus Hasbro, and then I try to project myself in the next 5, 10, 15 years, I'm pretty sure that Algonquin will do better. Maybe I'm wrong. We'll just know in 10 years. But right now, I'm a lot more excited to hold that renewable energy utilities that also have like 60% or 65% of their revenue that are regulated. So very stable, great dividend growth perspective here. So I'm kind of like just improving my portfolio by shifting sectors and improving the dividend growth of this company. All that to say that I've made that move. I'm very happy about it. It will now be published in my next report. And in that report, when I receive it around like end of June, beginning of July, I will do the exact same method, the exact same strategy. I'll look at my sector allocation. I'll look at my ratings. I'm going to take some notes there. Then I'm going to look at each of my holdings weight to make sure that I'm not equally weighted, but there's not like a few stocks that are completely outstanding here. Maybe I'm going to take this opportunity to sell a few shares of one and then buy the others to make sure that they are a little bit more even. Once I've done that, I will look into each quarterly earnings for all of my holdings, make sure that everything is in order. And if there's like any companies that I'm not too sure about, I will look at my potential replacement list, get excited about one, and decide if I make a transaction or not. The key here is not to shuffle your deck all the time and then buy and sell stocks. In general, I will make 2, maybe 3 trades per year. So it's really more like a laid back buy and hold strategy, but you still need to be active. At one point, Hasbro did good in my portfolio. It was doing well. Now, not so much. Time to move on, find another one, and there you go. I'm pretty sure that you have noticed that I have not talked about returns, and I don't look at returns right away, and this is pretty much the last part of my process. Is just I look at how I've done, but not for the quarter, because even 1 year or 2 years, 3 years, I found it's a little bit short term. I would like to look at 5, 10, 15 years. That's a lot more relevant, because you can get lucky for a year or two. It's hard to get lucky after past 5 years, right? And this is what we see with professional portfolio managers. Like, you have like a lot of stars in that industry, but the key there is the real one are being good not only for a few years, but for a few, like at least 5 years, but sometimes a few decades, and those are very rare. And this is what I'm trying to do. I'm not saying I'm gonna reach it, but this is pretty much the process. If you're curious, here are my results. As you can see over there, my portfolio value is now at $206,000. This is as of April 7th, so it's not like brand new. It was done last month. New numbers will come in, but I'm not in a rush as usual to publish them, just because I'm not chasing news. I'm not chasing trends. I don't mind too much what's going on in the market. The returns have been very great. So total returns since inception, which was September 2017, I am at 90%, so almost doubled in 3 years and a half. So it's doing pretty well. Annualized return almost 20% per year. Got helped by the market, obviously. Got helped by the fact that I'm heavily invested in tech stocks. Those are just circumstantial. It will be a lot more interesting in 5, 10, 15 years, as I mentioned earlier. But at least it gives you an idea of how I manage my money. I hope that it has helped you, giving you some ideas to go through your quarter efficiently, not to waste too much time, but not to ignore news that could potentially harm your retirement plan. And I think this is the important part here. So follow your stocks, make sure they fit with your investing strategy. Don't focus too much on investing returns, but trust your process. If you have enjoyed this video, make sure that you subscribe to my channel. I'm posting a new video every single week, trying to help out investors like you invest with conviction and retire happy. And until next video, until next week, stay invested.